Good afternoon. My name is Jerry Frank, and I'm the co-founder of STRATAFOLIO. STRATAFOLIO is an online software that provides asset management and automation for companies that own and manage commercial real estate. Not only do we provide a product to help real estate owners work more profitably and efficiently, but we're always looking for opportunities to educate our customers as well as which brings us to today's topic. For today's webinar, we are excited to welcome Trevor McCandless, who is president of Fusion CPA. Today is a very full day, lots of good stuff to cover. This presentation will run about 30 minutes, so please submit your questions in the chat, and we will address your specific questions offline because this is going to be a fairly full session. But we will make sure we get back to you. The webinar will be recorded, and it will be available for you to listen to at a later time. So with that, I'm going to turn this webinar over to Trevor so he can get us started. Welcome, Trevor.
Thank you very much. Let me take control here. There we go. And we'll get to this little slide. So hello, everyone. I'm Trevor McCandless of Fusion CPA. So we're going to get a little bit nerdy today. So if you get a little antsy, just hold tight because that's what we're talking about. We're talking about taxes. We're talking about accounting and really how they relate to closing out the year. I mean, we're in December here. It's a hot time to get your numbers right as we're launching into 2020. So Jerry, really glad to be here with you and the STRATAFOLIO team. I have a ton of fun with this topic because we're able to make such a huge and really positive impact on our clients' lives and helping to really put more money into our clients' pockets. And let's face it, that's a big reason why we're all entrepreneurs here. I'm a big entrepreneur as well. And so for a little bit of background, I lead a team of brilliant CPAs here over at Fusion CPA, and we're a super technology forward tax and accounting and advisory CPA firm. And one of our specialties is indeed working with real estate entrepreneurs. We have a ton of fun with it. I started Fusion CPA in 2011. We were recently listed as the only CPA firm in the Gator 100 of fastest growing University of Florida alumni companies, so super proud of that. I got to do a disclaimer, as you always do when giving technical talks like this. So a quick disclaimer, we're covering tax planning and accounting principles at a high level, and that while I'm a CPA, and of course we're all CPAs in our team, you need to engage your own CPA or us for custom specific advice for your unique situation. So that being said, let's dive into it. So the slide you're looking at, it describes kind of the three phases of how Fusion is keeping everything connected for our clients. And so we're going to cover these topics as they relate to closing out the year within these three phases. The first phase is the stabilization phase. And we'll discuss kind of common action items for closing the books at year end. The second phase we refer to as the analysis phase. And we'll discuss some common topics around, during that analysis phase, after we've completed stabilization, what are some of the qualified tax deductions is a common question that we get. And also we'll discuss depreciation for commercial properties, especially in light of the 2017 tax reform, which was major. And then we're going to touch on some of the methods of estimating and budgeting for your upcoming tax liabilities. And this is stuff that you're going to be able to take in for every single year that you're operating. Same principles apply. And then finally, in the third phase, we refer to it as the growth phase. And in this phase, we're discussing looking into 2020 and talking through an example of diving deeper into your numbers for ways really to generate more excess cash flow. So with that, let's dive into the first phase. Okay. So phase one, stabilization, what records should be updated at the end of the year? We list out 3 really to focus on for reconciliations in this closeout process. You're going to see here on the screen, right? Bank and credit card accounts, escrow accounts, loan payments, super common and ordinary within the commercial real estate community. So, the first being bank and credit card accounts, reconciling and including all transaction from your properties and your entities accounts is absolutely mandatory. You got to realize that everything we do in phase 2 and phase 3 is completely dependent on the accuracy of phase 1. So if you aren't the one managing your accounting or your QuickBooks files, that's probably the most popular platform out there, you may have no idea to actually how to check this. And that's really common for owners, and that's okay. But first of all, you should at least have access to your QuickBooks files. Even if, it's an internal team or an outsourced team that's not doing the day-to-day entry, you need to have access. And so the action item here is for you as the owner or the finance lead or CFO to go ahead and run a balance sheet report and then eyeball the balances of your bank accounts and credit card accounts, those statements. So if you're with, say, Bank of America, look at the 1231 statement and compare the balance on the statement to the balance in your QuickBooks account. And if they match, fantastic. But if there's differences, you need to start asking a lot of questions, and specifically, why the heck are these different? If you're managing it yourself, you need to call us, and we can kind of walk you through, potentially correcting it. There might be, big problems if you're seeing negative balances in your financials within the cash accounts or the debt accounts. Fortunately, these all can be fixed, as I said. One of the problematic ones that might happen if you're seeing big differences is that if there's missing transactions, if there's double counted transactions, or simply some of these transactions are misclassified. Those are the kind of 3 common areas. So, escrow accounts, very similar to what you're going to do in a checking and credit card reconciliation process. What I would add here is to compare these escrow accounts to whatever kind of contracts you have in place. Escrow accounts can be used for a ton of different things, but be sure to compare the amounts that you have in the escrow accounts to your lease contracts, to the closing statements, whatever you're using that escrow account for. If you're delegating this reconciliation step to somebody internally who hates reading legal contracts, a lot of people out there do, and I understand, you're likely going to find errors, or you may never even know about them if you're not kind of overseeing this delegation step. So be very careful there. In regards to loan payment reconciliations, you'd be surprised how often we see this screwed up. The action item for your team is to make sure that you have, number 1, your amortization schedules in hand, and 2, compare them to the financial statements. So first, you're going to make sure the debt balances on your balance sheet that we mentioned before that you're running out of QuickBooks matches the debt balance as reported on, number 1, your mortgage or line of credit statements, and number 2, the amortization tables. So then second, we want to confirm that the interest deduction, that's the other side of course, any kind of mortgage payment, is on your income statement, matches the interest payments on your year-end mortgage statements, as well as the amortization schedules. A lot of times we see people not really pay attention to the amortization schedule, but it's very important because things can differ, and I'll touch on that just right now. So where we see misreporting is, number 1, where we see accountants or owners trying to deduct maybe the entire mortgage payment that's principal and interest on the income statement. And this is super common among do-it-yourselfers. It can be corrected, of course, but a number 2 kind of item of misreporting is when we see the entire loan payment then being treated as a distribution, which is essentially a return of capital, which by default is not even deductible. And we know that interest expense of that mortgage payment is indeed deductible. So we want to get that corrected. The 3 most common kind of piece of misreporting that we see there is that there might have been some kind of mid-year change to the accuracy of the amortization schedule. And this can happen if a payment was missed, or maybe terms of the deal, the debt deal was renegotiated maybe on interest rates, but then also maybe if there's some kind of debt forgiveness, that can all kind of change the amortization schedule. So in this light, phase one, the stabilization phase can be very smooth. I think a lot of it depends really on, if you're managing the accounting yourself or you're having an outside party kind of help oversee that accounting for you, and that's really where we come into play. So with that, let's dive into the second phase. And so we kind of broke this out into two parts. I mean, with each of these topics, I could legitimately spend like an hour and a half, 2 hours, if not more, rambling on about them. But we kind of want to break these up to two parts. So as I said, phase two is completely dependent on the accuracy of phase one. For most of our clients, we are handling the adjusting journal entries and the reconciliations and the prior slide in phase one that we mentioned, but we do have clients that have high quality internal accountants that we can kind of just coordinate towards the end of the year with, and that works as well. In part one of this section, I want to touch on qualified tax deductions and depreciation, either via bonus depreciation or Section 179 depreciation. With the tax reform, these forms of depreciation have really taken on a new light, so it's important to highlight here. I wanted to make an important point of touching on that in this conversation. So qualified deductions. A common question that we get is, hey, what can I deduct? What is a qualified business deduction? And it's interesting. You could Google it, right? And the IRS would have some very generic language, such as, a deductible expense is ordinary and necessary, something that is incurred in the carrying on of your business. And anytime you say that to someone, it's always just going to raise more questions like, what the heck does that mean? And so you have to dive deeper into what ordinary and necessary means. And I commonly like to think of ordinary expenses as those that really are helping to further the growth and sustainability of your venture. You're not expenses that are really just like, putting food in your mouth or drinking water, those ones to keep you personally alive. This is about sustaining your venture. So for example, paying your real estate taxes on your commercial property. Obviously that's deductible. It's helping you to sustain your ownership in that property. Paying vendors, employees necessary to running your business. So we're checking a lot of boxes there. What likely does not qualify, or the vacation that you and your spouse are going to take to Italy for Christmas, really no business purpose there. Let's not try to even run that through your accounting files. So that is that first section of qualified tax deductions. Speaking at a high level, the next one we want to talk about, where we're going to get definitely a little bit more technical here, is depreciation and the Section 179 deduction. So I'm sure most of you have heard of such things as maybe cost segregation studies. We mostly speak of cost segregation studies for newly built properties or newly acquired properties that are really large in scale. We're talking $2+ million, $3 million, $4 million, $10 million kind of dollar properties. But if we've got a $500,000 property, we can still achieve the same thing that we're trying to do in a cost seg study, but we can just do it manually. It's just the dollars aren't as big. So the goal of the cost segregation study is to identify and separate the assets that have been acquired in any given transaction that may be depreciated over shorter time frames than the entire building. So for example, if we acquire a property for $1 million, we may be able to identify $50,000 of carpeting that may be depreciated and deducted over 5 years versus 39 years. So what this achieves is the ability to speed up deductions and further reduce your taxable income in the current year versus later years. And so if you think about the time value of money and saying, dollar for dollar, we'd rather save now versus later, if all things are held equal, think of it like, if I'm able to save my tax dollars now and put it to work, whether it's buying another property or putting it in an interest-bearing account, I'm going to make that money now over 12 months versus waiting 12 months to begin making money. I've got 12 months of opportunity cost that I've made. So it should be noted sometimes owners should not want to speed up deductions. So this is something that really got to think through. And the reason why you might not want to speed up deductions is that if you have other properties or businesses that are generating losses in maybe these early years in the short term, you might not have much taxable income. And generally, we want to be able to time deductions in years where we have the most taxable income and when we are in the higher tax brackets than in years when we're in lower tax brackets. So again, it's a conversation to be had. So that being said, if we have significant, positive net income, let's look at how we can speed it up. So with the tax reform that came out in 2017, we have a new 100% bonus depreciation on eligible assets on acquisitions, new construction, and renovation, whereas this used to be 50%. Okay, so a decent kind of difference there. Now, note, there's lots of different rules within this bonus depreciation world. Like, for example, in 2023, it moves from 100% to 80%, et cetera, but I won't waste time on that kind of stuff. So this bonus depreciation on eligible assets. So, for example, a 5-year tangible property like identifying carpeting, wallpaper, interior glass, cabinets that are built in, sinks in the break room, these are eligible for this 100% bonus depreciation. Now there's also, 15-year land improvements. And now remember, land improvements are very different than building improvements. So such things as landscaping, signage, anything you see outside of the building, parking lots, sidewalks, these are also available for the 100% bonus depreciation. Now that differs, as I said, from building improvements. And this is an interesting thing where, when they were drafting this tax reform, they were rushing it out at the end of the year, and they forgot some language that was critical, but we were able to get corrections to some degree later. So like building improvements, a 15-year asset is not eligible for bonus, but fortunately it is eligible for the Section 179 depreciation. So now you might want to, if you're looking at this webinar later, you might want to pause and let that marinate, and especially think on this next couple statements, because very important note though, that Section 179 property can only be depreciated up to the amount of positive net income, whereas bonus depreciation can create a loss. So for example, if we have a $20,000, if we have a property that's generating $20,000 in net income, but we have a $50,000, asset of 179 property, we can only deduct $20,000, taking it to zero of that $50,000 of potential depreciation. And so again, 179 cannot create a loss. It can only be depreciated up to your amount of positive income, whereas a bonus depreciation can. So I rambled through that. That's a lot of information. But so let's dive into part 2 on how to calculate estimated tax liabilities. Okay, so in part 2, we're going to discuss tax budgeting and how to quickly estimate tax liabilities. So, but before we dive into these, I want to go on a slight tangent about the differences between net income, for which your taxes are based off of, and cash flow. Because quite frequently, entrepreneurs will confuse the two when thinking about how much taxes they may owe or not owe. So in commercial real estate versus, say, professional services companies like the one I'm in, like accounting or law, the differences between net income and net cash flow are far greater in commercial real estate because there's just so much more. It's much more of a capital intensive business. So that being said, I want to give you an example of how depreciation kind of makes that difference between net income and cash flow. So for example, while we may have $100,000 of cash on hand, we may only have $20,000 of net income for which we're taxed. And that is due to the depreciation deduction, which is essentially a paper deduction. And depreciation, it's one of these few deductions where cash isn't actually coming out of your pocket. You actually paid for it back when you acquired the property or paid whoever to renovate the asset, but due to real estate tax law, it has to be expensed over a longer period of time. So in a similar manner, loans and debt also create a similar difference in net income and cash flow. So for example, when a loan is being paid off in any given year, you may have $100,000 in net income, but $20,000 of cash on hand. But in this case, you're being taxed on the $100,000 because when you're paying off the debt, it's not deductible. It's not reducing that $80,000 that you just paid off, doesn't reduce your taxable income. So I just wanted to beat that home, that, you know, cash on hand and cash flow is very different than net income for which you're being taxed on, because it's really, I want to mention it because it's really often confused. So let's chat about how to estimate your tax liability in a proactive manner. So I think of it in two different methods, really a complex method, which is the most accurate method, and a more simplified method that was kind of, you know, quick and dirty, and I'll explain that in a sec. So in the complex method, we're going to really proactively prepare a full tax return with all of the information that you have for the coming year. So most of the time your CPA is going to do this behind the scenes. So, you know, don't let that slow you down from getting these calculations done. It's all really being handled for you by your CPA. So for example, if it's June of 2020 next year, and we want to accurately know what our 2020 tax liability is looking like, what we're going to do on the CPA end is roll over all the prior year 2019 information that we know of, edit those changes for the prior year for any kind of new sources of income from 2020. And we're also going to add in any kind of new acquisitions or dispositions as well. So in this example, we're doing this in June with some assumptions also that of the performance for the final 6 or 7 months of 2020. So a lot of times, especially what sector of real estate you're in, like if you're a real estate broker without rental homes, you may have huge swings of income in any given quarter, and that's fine. And these tax payments are called quarterly estimated tax payments. So if we kind of estimated a little low in the second quarter, that's fine. We can catch it up in the third quarter. Again, these are estimates, and we can redo these every single quarter if we wanted to. So then there's the more simplified method. We're really not, as CPAs, preparing a whole kind of tax return and doing a whole projection. This is really better. The simplified method is really better if there's really little to no changes in the amounts and sources of your net income of your companies and properties from the prior year. So in this scenario, you can simply look at your prior year tax return and divide your taxable income by your total tax calculation. It's kind of funky, so what I'm going to do is I'm going to tell you exactly where to look on your tax return, maybe from 2018, and you'll get an idea. But what this math is doing is that it's bringing us to what's called an effective tax rate, or otherwise known as an average tax rate. And that gives you, just as it says, an average tax rate across all of the marginal tax brackets. So if you've got a pen, you're going to want to write this down so you know where to look at it. So if you're looking at your 2019 tax forms, you can find the taxable income number on line 11B of page 1 of the Form 1040. And then the total tax amount can be found on page 2 of the Form 1040 on line 16. Simple math. And then you have your average tax. This is great for kind of a do-it-yourselfer. If you want to get kind of just a quick calculation to kind of know how much to budget for. So then boom, you're done with your tax calculation. Best practice note, after we've established what your estimated tax liability is going to be, we commonly like to recommend, hey, move these funds into a separate checking account that is somewhat out of sight, out of mind, so you don't go kind of spending that tax budget. I know it's extremely tempting when you have a ton of different investment options and things to do with your money. Hey, sometimes we may say, don't even worry about paying the estimate, pay the penalties, because you can make more money on your money in certain projects. But if you're the type that really wants to kind of not owe $1 at tax day, that's a good method of just kind of keeping it out of sight, out of mind. Quickly, I'll give you a couple of dates that you should put in your calendars that estimated quarterly tax payments are due. April 15th, June 15th, September 15th, and January 15th. So FYI, you can also do a little Google and you'll see those, but I would definitely say put those in your calendars. So at this point, we've covered stabilizing as well as analyzing in the first two phases. So it's now time to go into the third phase, which, using the data that we have, we're going to try to make more money and maximize cash flow. So with that, I'd like to share a story of, what we were recently able to do with one of our clients. This client came to us is the first one that kind of came to mind. He's in the real estate business. This one specifically was in the mortgage refinancing business. And he called me up not too long ago and was super stressed. As he put it, he felt like he was swapping dollars. In other words, cash was coming in and going right back out. He said, Trevor, man, I'm a sales guy. I know how to close the deal, and then I'm on to the next. I really don't know what these numbers mean. And so at the time, we were just doing bookkeeping and tax work, and he said, man, let's activate phase 3. Let's activate the CFO consulting side of things because I'm hurting here. I can feel it. I'm flying blind, as he put it. So long story short, we helped him grow his bottom line, his take-home cash, by another $20,000 per month in just 40 to 45 days. How did we get there? In the first step, we started with analyzing his sales and marketing efforts, what was driving his sales, and what were the associated costs of driving those sales. He had a large advertising spend, so we began by analyzing the ROI, the return on investment, of each of the mediums he was advertising on. Very quickly, we were able to find, or we were able to determine that one of these platforms, that for every dollar he spent, he was generating $15 in gross revenues. So a 15-to-1 ROI. That's ridiculous. That is just a beautiful thing. So as you can imagine, we froze spending on all of the other platforms and reallocated all of the budget to just that one. So boom, done with step 2. Second step is then to analyze the expense side, analyze what his sales costs were. And lo and behold, we were able to see, and we see this all the time, when he started the company, he gave a real sweetheart deal to his only other employee, who is quote unquote VP of sales. His comp, the VP of sales, his comp was 20% off the top of all revenues brought into the business. Okay, you can kind of think about now, oh crap, if you don't get that corrected as y'all grow, that could be bad, and that was the deal. So regardless of whether his team was closing a deal, this gentleman was getting 20%, whether he was involved or not. So the sales guy was making at the end of the day more cash than the owner without any of the risk, without any of the expenses, nothing. So then our second step was then renegotiating really a proper compensation plan that was aligned with his role. And it was, when I walked into his office to kind of have this conversation, he was like, yeah, man, I was wondering when this was going to happen. And we just kind of laughed. And he's still with the company today. That's a great fit. He's making the dollars that he should be. But these steps and taking a step back and looking at it resulted in another $20,000 per month in our client's pocket. So, how would you like another $20,000 in your pocket every month? I'd love it, honestly. But guess what? Also, that this was just analyzing his sales and marketing, not even beginning to dive into his true operational structure that he had in place. And if you have your pencil, another little opportunity to write something down, there's a great book out there called the EOS Traction. We actually follow this framework of the traction methodology when we're consulting in this third phase of growth execution. And we also give the leadership team of our clients a copy of the book, so we can all really begin speaking the same kind of growth-oriented language. And trust me, it is a ton of fun because really we're growing and we're making more money and we're streamlining our operations. It's a ton of fun. We actually have one more cool little thing for you guys. So we made this little checklist to kind of recap the conversation and these kind of 3 phases of keeping everything connected. So we'll also email you this checklist for everyone that recaps what we're speaking about. So, hey, Jerry, it's been a pleasure doing this with you guys. I hope it's been helpful. I know you probably want to say a couple more things as well, and I'll hand it back over to you.
All right. Well, thank you, Trevor, and great story. And thank you, everyone who has taken time to join the webinar. And like Trevor and his team, our goal at STRATAFOLIO is to help real estate owners work more efficiently and quickly. And we do this by connecting directly to QuickBooks so you can truly manage all of your assets in one place. And we're happy to announce that you can find us live on the QuickBooks Online Marketplace, so you can go check us out there. And if you joined this webinar, it was because you wanted to run your business better. And STRATAFOLIO helps owners do just that. And we help in 4 major areas across your entire portfolio: cash flow management, debt management, lease management, now including CAM reconciliation. Lots of people are pretty excited about that. And finally, we help with investor management. All right, so one last thing before we sign off. A recording of this video and the associated blog will be available later. So we'll email that out to everyone, and the checklist as well. Thank you for joining, and don't forget to follow us on Facebook, YouTube, Twitter, and Instagram so you can learn about other exciting product announcements and educational programming as well. Take care. Thank you, everyone.